So we're starting out with our next subject today, which is on fixed income. Year after year, surveys are conducted by the CFA Institute asking candidates, which subject did you find the easiest, toughest on the CFA program? Fixed income ranks among the top few, where fixed income is regarded as one of the challenging subjects. And the reason I believe that it is tough is because of lack of familiarity. Most of you may have a background in finance, and if you do have a background in finance, you may have dabbled yourself with a bit of equity, bit of mutual funds, bit of insurance, bit of other products. Bonds and fixed income is something, especially on the valuation side, a lot of people haven't gone to the depth that the content here does. No other bachelor's course tends to do it as much, and therefore there's lack of familiarity, and that's why fixed income causes a little bit of challenge on the content. I won't say it's a difficult subject, no way I would say it's a very difficult subject. I think it was one of the subjects that I used to find challenging when as a student, but over time that I've taught this subject, to be very honest with you, this is one of my favorites. So let's start with the idea of fixed income and what this topic stands for. In this subject, we are going to talk about the topic of bonds. What are bonds? There are going to be about 6 chapters in total that we're going to discuss. In today's class, I'm going to hopefully, if I can cover chapter 1 itself, I will be super happy. So chapter 1, we'll talk about the defining elements of what are bonds, what are the various types of bonds, structure of bonds, the various features that are there in the bond. We'll talk about the legal, the tax considerations that are there, the structure of cash flows, covenants, and some provisions like call option, put option on the bonds. We'll cover the rest of the chapters in the subsequent weekend, probably on the next week when we are coming back. But fixed income, the chapter number 3 is probably the longer one and the tougher one. The rest of the chapters are not that difficult. To start with, let me start by simply saying that fixed income is a contract, is a financial contract. It's a bond where there are 2 parties involved. There is a borrower and there is a lender. I would really like you to participate as much as possible. So when I ask you a question, try and participate, try and keep, participating in the class. That's what will make the class interactive. Okay. And it'll be better for you to learn that way. So there's a borrower and there's a lender. They are the 2 parties who are involved in the contract. What does the borrower and the lender do at time 0? So at time 0, when they enter into the contract, what is the contract like? The lender lends money to the borrower. What does the borrower give to the lender? Yes. So if the lender is giving money to the borrower is borrowing the money. What is the borrower giving to the lender?
Assurance, trust.
Yes, very good. The borrower gives back a promise at time 0. At time 0, the borrower says, I promise to pay you back with the certain terms and conditions that you have set at time 0. Isn't it? This contract that is being signed between the borrower and the lender is called as a bond. In fact, this promise is called as a bond. This promise is a bond. Who is providing that promise? Who is issuing that promise? This guy is said to be the issuer. He is the guy who's issuing the promise. He's signing the document. He's saying, I promise to pay. And he is called the holder of this document, the bond. Each one of you today holds a bond in your pocket. Each one of you holds a bond in your pocket. You can open up the currency note, and on the currency note, it would say, I promise to pay. Who is the issuer? The central bank. He is the one who signed that document. You, whose pocket it lies in, you are the holder. You are the owner. So you are the owner and he is the issuer of this document. Okay? And this itself is a bond. It's a promise. It's a promissory document. All bonds have some common features attached to it. First, every bond has a par value, also called as face value. So every bond has a par value or a face value. This face value or par value is usually in the multiples of tens or hundreds. In order to make calculation simpler, I mean, of course, it could have been 13.36 also. Any arbitrary number is also okay. But why are we, why, for example, why do we have currency notes of 10, 20, 50, 100, 200, 500, 2000? Why not of 13.67 and 43.28 and all of that? Why don't we have currency notes like that? It's easier for their multiples, right? It's easy for the multiples, the calculations to be done. It's easier. We all understand that. So the face value of a bond is generally 100 or 1000. Generally either 100 or 1000. That's the face value or the par value. And what does this par value indicate? This is the amount of money which represents the principal amount that the borrower has borrowed. And this money, the principal, has to be returned back by the borrower to the lender at maturity, which means that every bond has a maturity. Every bond seems to have a maturity. And what is the maturity? The maturity is the time period for which this loan has been taken. The bonds can be very short term. They could be overnight, or they could be very long term bonds where they are 30-year bonds, where the loan has been taken for a very long period. In fact, to the other extreme, sometimes the bonds can even be perpetual bonds. Perpetual bonds means that I've taken a loan from you, I will never pay it back. I will keep paying back the regular coupon interest to you. So maturity can range from overnight to perpetual as well. Generally, perpetual bonds are rare. Most bonds have a maturity between overnight to about 30 years. Overnight means one day, and 30 years means a very long time period. Every bond has a coupon rate. Every bond has a coupon rate. What is coupon rate? Coupon rate is a certain percentage. Coupon rate is a percentage, and this percentage is a percentage of the par. The par value is either 100 or 1000. This coupon is a percentage of the par value, and it represents the regular cash that the borrower pays to the lender. Very often people call it as interest, which is not necessary. We will discuss today and explain to you that interest rate and coupon rate may not represent the same thing. Interest rate is what you should be paying. Coupon rate is what you are paying. And the two may or may not match. So coupon rate is mentioned physically in the document. It's a mentioned number. It's a percentage of the par value, and it represents the cash flow that the borrower pays to the lender. Coupon rate can be of two types. Coupon rate can be of two types. It can either be fixed or it can be floating. What is the title of our chapter that we are studying? What is the title of the subject that we are studying? The subject that we are studying is called as fixed income. The subject that we are studying today is called as fixed income. So what is fixed? What is fixed? The coupon is fixed. Let me tell you something very interesting today. What out of all the entire wealth in the entire world? So if you were to add up the wealth of every person in the planet, every company, every government, every person's wealth should be added up. What is the largest asset class? Which is the largest asset class in the world today? You know that? Anybody wants to take a guess? Which is the largest asset class in the world that exists today? That's correct, Rishabh. The largest asset class is real estate. Real estate is the largest asset class. It comprises almost about 50% of the wealth of the world. How about the second largest asset class? How about the second largest asset class? Which one do you think is that? And that's correct too, again, Rishabh. That is fixed income, debt. Debt, which is the subject that we are studying today, is the second largest asset class in the world. And a majority of this debt loan is taken at fixed rate of interest. Floating rates do exist, but if I were to look at the proportion of all the bonds that are traded in the market, all the bonds that are issued in the market, about 80 to 85% of the debt that is taken up in the market is of fixed rate, which doesn't mean that the floating rate bonds don't exist. They do, but these are rare. They are lesser as compared to the fixed income. So in this chapter, in the subject, we are going to study about fixed income majorly. Almost about 85% of the content that you're going to study about is about fixed income. And floating rate bonds, we will study about them, but we will study less. What do you mean by fixed rate bonds? Fixed rate bonds, the coupon rate is fixed. Coupon rate is mentioned at the beginning itself. Let's say 10%. So you will pay 10% of the par value. And then along with that, it is also mentioned about the periodicity of payment. So the periodicity could be annual, semi-annual, quarterly, monthly, daily. Different periodicities exist of payments. If nothing is mentioned in the bond, something is mentioned generally, but in your content, when you're studying the CFA material, if nothing is mentioned about the bond, we are going to assume that the payment structure for fixed income bonds is semi-annual. So fixed income bonds generally have a semi-annual payment structure. So if 10% is to be paid, 5% will be paid at the end of first 6 months, and the next 5% will be paid at the end of next 6 months. So coupon rates will be split into two parts, 5%, 5%, and then be paid at the end of 6 months and 6 months. Floating rate bonds are generally quarterly. Floating rate bonds are generally quarterly, not necessarily semi-annual, but by default, we will assume they'll be quarterly. This is the periodicity of payments. For fixed income bonds, you saw that the coupon rate is fixed. But for floating rate bonds, the coupon rate can be of two types. So now we're discussing about floating rate bonds for a second. Floating rate bonds, the coupon rate can be of two types. It could be either a direct floater or it could be an indirect floater. What is a direct and indirect? Direct means that when we say floating rates are there's a rates are changing, it has to be related to something. So coupon rates which are directly related to the reference rate, they have a reference rate plus a certain margin. Okay, that's the formula that by which generally the coupon rates are mentioned. What is this reference rate? Reference rate is generally the bank rate, and the most popular bank rate in the world is LIBOR. So LIBOR is a international dollar rate which is used for reference for most floating rate loans. And this rate changes on a everyday basis. Every day, every fraction of a second, just like every other asset price changes, LIBOR rates also change all the time. So coupon rate is equal to LIBOR rate plus a certain margin. Margin here is referred to as, let's say, certain bips. So let's say 250 bips. So if LIBOR is, let's say, 3%, the borrower will have to pay 3 plus 2.5. So that means 5.5%. If the LIBOR rate is 10%, the borrower would have to pay 12.5%. And why are we adding a margin? Because the borrower's credit worthiness is probably not as good as that of a bank. So if you as a borrower were to borrow, then your rate will be higher as compared to that of another bank. For example, if ICICI was to borrow money from HDFC, they will lend to each other at the interbank rate. Because banks and banks trade with themselves every day and their trustworthiness is much higher. But if I were to go to the bank to borrow money, the bank will lend me money at the interbank rate plus a certain margin. The extra margin will be charged because my credit worthiness may not be as good as that of a bank. So they may charge me this amount extra. And this extra margin is usually decided at time zero. It's decided at time zero based on the credit worthiness of the borrower at time zero. Of course, the credit worthiness of the borrower can change over time, but that is not going to change the margin. That's why this margin is called as the quoted margin. The quoted margin is mentioned in the bond document that yes, whatever is the LIBOR rate plus a quoted margin will be charged to you as a borrower. Okay, and this number becomes fixed at time zero itself.
Sir,
Yes.
sir, I haven't understood this 250 BPS and like LIBOR. Okay, it's a reference rate.
250 bips means in this case means 2.5%, 2.5%.
Okay.
Okay. So if LIBOR interest rate was 5%, you would pay 5% plus 2.5%. If LIBOR rate was 6%, you would pay 6% plus 2.5%. And this number would be different for different borrowers. If you were to go and you were a better borrower than me, you might be able to bargain with the lender at about 100 BPS extra. Say for example, now listen to this very interesting example. Say for example, there is a company which is very, very good, which is even better than, let's say, lending to a bank. Let's say there is one company who has amazing credit worthiness, brilliant, better than most banks also. He may be able to bargain a negative margin. He may say, sir, I am better than most other banks who are borrowing from you. I can borrow money from you at, let's say, rate of LIBOR minus 50 bips. So if the market rate, if you're lending to banks at 10%, lend it to me at 9.5%. That's rare, very rare, but possible. So margin would indicate the riskiness of the borrower in addition to the interbank rates. This is called as a direct floater. Why is it a direct floater? Because if the LIBOR rate increases, the coupon rate goes up. If the LIBOR rate falls, the coupon rate falls. So the relationship between the reference rate and the coupon rate is direct. Then you have a concept of indirect floaters. Remember, we are still talking about floating rate bonds.
Excuse me, sir.
Yes, Divani.
Sir, the reference we take LIBOR, is it necessary or are you taking just an example?
I'm taking it as an example. So LIBOR is used in the context of dollar loans. If the loan was a rupee loan, the interbank rate would be MIBOR, MIBOR. MIBOR refers to Mumbai interbank offered rate. LIBOR refers to London interbank offered rate. Every currency has a interbank rate. For example, there is Euribor. Euribor is for euro. So every currency would have its own interbank rate. I am using the one which has a reference of dollars.
So this we decide as per the country we're dealing with.
Absolutely. So not the country, currency.
Yeah, okay, sir. Good.
Because country can be
Yeah, got it,
different,
sir.
currency is more important
Yes,
here.
the currency.
Because
Okay.
HDFC Bank could be borrowing in dollars. Isn't it? They might have to pay somebody dollars, so they are borrowing in dollars. What will be the reference rate for them then? LIBOR. Make sense?
Okay. Yes, sir.
What's an indirect floater? An indirect floater is where the relationship between the reference rate and the coupon rate is indirect. For example, this could be 10% minus LIBOR. Where if the LIBOR rate increases, where the LIBOR rate goes up, the coupon rate might go down. And vice versa, if the LIBOR rate goes down, the coupon rate goes up. For example, let's put numbers. If the LIBOR rate was, let's say, 4%, the coupon rate would be 6%. If the LIBOR rate goes up to 8%, the coupon rate would drop to 2%. So there's an inverse relationship between the reference rate in the market and what the borrower needs to pay. What is very fascinating is, what if the LIBOR rate goes to 12%? What happens in that regard? Can you imagine? What will be the reference? What will be the interest rate if the LIBOR rate goes to 12%? What will be the coupon rate? Tell me.
2%.
Negative. Will it be negative 2%? What do you mean by negative 2% coupon rate? This sounds very odd. As they would say in Hindi, कि गंगा उल्टी बहने शुरू हो गई है. Why? Because a minus 2% coupon rate means that the lender needs to pay to the borrower interest. Can you believe that? Is it possible? Is this possible that the lender has to pay, that say, sir, I had lent you money, interest is due, here is your coupon? Sounds a little odd, isn't it? So, in order to avoid such circumstances where these formulas end up throwing out very odd circumstances, floating rate bonds very often have, so floating bonds have a feature in them which are called as caps and floors. So recognize this. The requirement of caps and floors is not required in case of fixed rate bonds. Caps and floors are required in floating rate bonds. What are caps and floors? Cap and floor, by the name of it, would put a maximum and a minimum limit to the coupon rate. So if the reference rate also changes, we may put a floor and say that the coupon rate cannot go below 2%, or we may put a cap that it cannot go beyond this number. So there could be limits being applied on the coupon rate at time zero itself to ensure that such situations don't arise, or to limit the amount of returns that the borrower is going to pay to the lender. Who is going to benefit with the cap? Who is going to benefit if there is a cap? Borrower or lender? If there is a cap on the floating rate bond, who will benefit due to this cap? The borrower. And who will benefit with the floor? The lender. Right? Now, from now onwards, I am no longer going to use the word borrower lender. From now onwards, whenever I'm covering the chapter of fixed income, I am no longer going to use the word borrower lender. I am going to use the word issuer and holder. So you will have to build comfort with these terminologies, because that's how the book and your content will refer them to. Borrower is that the issuer, the lender is the holder. So who benefits with the cap? The issuer. Who benefits with the floor? The holder. All right. So what is it that we have discussed? We have discussed what are bonds. They have a par value, a maturity, a coupon rate, the types of coupon rates, the fixed and the floating rate bonds. And every bond has terms and conditions. The terms and conditions are of two types: the do's and the don'ts. By the name of it, do is what you got to do. Don't is what you don't have to do. Sounds very simple. Do is called as affirmative and don't is called as negative. And these terms and conditions are called as covenants. So my spelling, when the way I write here, it becomes on a pen becomes difficult. So covenants. So terms and conditions are do's and don'ts. These are the covenants. There are two types of covenants: the affirmative covenants and the negative covenants. Affirmative covenants could be like pay your interest on time. Affirmative covenant could be maintain a debt to equity ratio of this much. A negative covenant could be that you cannot sell the asset against which you have taken a loan. A negative covenant could be restricting the borrower to do certain things. For example, not taking another loan. So this is a restriction. So if the work of the borrower, if something of the borrower is, there is some restriction being applied on his actions, that's a negative covenant. And this is, he's asking him to do something. Okay. So these terms and conditions are there, and everything is mentioned in the bond document upfront itself. And at the bottom of the document, one person will sign, whose signature is the most relevant, because he is the one who is agreeing to those terms and conditions, right? Somebody signs. Who is the person whose signature is the most relevant? Issuer. So the issuer would agree to the terms and conditions and everything that's been signed. Maybe the holder also signs the document, but his signature is not relevant. The signature of this guy is very important. Identifying who's the borrower, whose signature it is, that's very relevant. All right. So let's start. What are the basic features of a bond? Bond is a contractual agreement between a borrower and a lender which specifies the rights and obligations between the issuer and the holder of a fixed income security. The lender lends money, the borrower agrees to pay back the money with certain terms and conditions to the lender. Every bond has a par value, maturity, coupon rate, and for floating rate bonds, they have a reference rate and plus a margin, which is usually mentioned. We spoke about two types of floating rate bonds, direct floater and indirect floaters. There are some bonds which are fixed rate bonds. There are some bonds which are fixed rate bonds. There are some bonds which are fixed rate bonds where the coupon rate is actually 0%. There are some bonds where the coupon rate is 0%. That means that there is no regular cash flow that the borrower pays to the lender. Does that mean that the borrower is not paying any interest? No. The borrower is paying an interest, but the method of payment is not regular. He will pay the entire sum of money at maturity in the end. This sort of a bond is called as a zero coupon bond. Zero coupon bond. Zero coupon bonds do not pay any regular coupons. They pay the par value at maturity. They usually pay 1,000 rupees at maturity. So the borrower will borrow less than 1,000. Let's say he will borrow 900 and he will pay back 1,000 at maturity. So this is the amount he gets at time 0, and this is the amount he lends at time 1. He gives back at time 1. The interest arises as the difference between what he had borrowed and what he pays back. So they pay the par value at maturity, and interest arises as the difference between the initial sales price and the par value. They're also called as deep discount bonds. Why are they called discount bonds? Because the bonds are issued at a discount to the par value. So with reference to the par, their issue price is less. That's why they're called as discount bonds. Okay. Every bond must also specify the currency. This might sound like very obvious things, but when I say 100 or 1,000, what 100? What 1,000? Is it like 100 chickens, 100 dogs? What currency? What is the denomination that you have to pay? So you have to mention very clearly, is it dollars? Is it pounds? Is it euro? What? So the currency denomination is very important, and you will realize this in a short while. It may sound like a very obvious thing that I'm discussing right now with you, but it's very important, very critical. So currency denomination, if a bond is aimed solely at domestic investors, for example, let's say there's a company called as Larsen and Toubro, who's wanting to take loans in India in Indian rupees. So he will take loan here itself in this currency, isn't it? That's called as a domestic bond. So sometimes money is required in the same currency in which the company is operating. But sometimes companies require money in international currency. For example, there is Infosys doing business in the US, needs to take a loan in dollars to pay off somebody there. He might raise a loan there in foreign currency, in that currency of the market. So issuers may issue in foreign currency if they are expecting cash flows in foreign currency. So their customer is going to pay them dollars. They have taken a loan in dollars. This helps in reducing the currency risk that they face, because the revenue and the expenditure then happens in the same currency. So the volatility in their top line due to the currency volatility automatically reduces. So issuers may choose to issue foreign currency if they are expecting cash flows in foreign currency, because the interest payments and the principal repayments act as a natural hedge, reducing the currency risk for the issuer. Some bonds are also called as dual currency bonds. Dual currency bonds. Dual currency bonds make a coupon payment in one currency and pay the par value at maturity in another currency. See, I'll tell you one thing very clear. These are the two parties, holder and issuer. They are the two parties, issuer and holder. If they agree to a certain kind of a contract, nobody can stop them from entering that contract. So what we are discussing here in this chapter today is that what are the various types of features that these people can enter into. There's no limitation in terms of what can they do. They can get into any kind of contract that they desire. There's no limitation to that regard. So the issuer and the holder can enter into any contract or any feature that they both mutually agree to. So dual currency bonds make coupon payments in one currency and the par value in another currency. There's another feature that could provide the holder the choice of which currency would he like to be paid in. This is called as a currency option bond. A currency option bond provides the holder the right to choose in which currency he wants the payment on the interest and the principal. Interesting, right? Where the holder has the choice.
Sir, like, can this thing be an example? Like, we paid the fees for CFA thing.
No.
Like, not
Did you
exactly.
pay for a bond?
No, not a bond. But yeah, we incurred some charges also into that currency thing.
But was that a loan anywhere?
No.
So unless there is a loan, it's not a bond.
Okay.
A bond is a loan. You have borrowed money. उधार. जब तक उधार नहीं है, तब तक वो bond नहीं है. Yes, you had an expenditure. Now, when you paid the CFA Institute a fees, it's possible that you took a loan to pay. The bank may have lent you money. The credit card company may have lent you money. That is a loan, not the expenditure. So let's not confuse an expenditure with a loan. Okay. I want to go back to this point on currency option bonds. Currency option bonds provide the bond holders the right to choose the currency in which they get the interest and the principal payments. Notice something. The holder is getting a choice. Is this choice a good thing or a bad thing? When you're being provided a choice of getting something, is the choice sounding like a good choice or a bad choice? No choice is ever bad. No choice is ever bad. If you are being provided choice of multiple things, the choice cannot be bad. Flexibility is always a good thing. Anybody who requires flexibility needs to pay for it. Nothing comes for free. Nothing comes for free. So if the holder desires this choice in this bond, the borrower will bargain and say that, sir, for this choice, I will pay you a slightly lesser rate as compared to another bond where the choice did not exist. It's like when you go to a shop and you buy a product. The product that you're wanting to buy has extra features. If the product has more features, it has to cost more. and there's no exception to the rule to this regard. It cannot have more features and be cheaper. Sounds ridiculous, right? Excuse me. Excuse me. Sorry. So what is very, very important to understand here is that if you want more features in a product or in a bond, and those features are going to support you, are going to help you, are going to provide you extra benefits, you have to pay for it. How does the holder pay for extra features on a bond? By accepting a lower return. Like, for example, we just spoke about a floor. If a bond has a floor is benefiting the holder will have to then accept a lower return as compared to another bond where the floor did not exist. Similarly, if the cap is being introduced on the bond, then the borrower is benefiting due to the cap. The borrower will have to pay a slightly higher rate as compared to another bond where the cap did not exist. In simple words, nothing comes for free. Every feature needs to be priced for. If the feature benefits the borrower, the rate that the borrower has to pay goes up. If the feature benefits the holder, the return that the holder can demand will decrease. Is this argument understood or not? If not, then tell me, I will dig deeper onto this, because this is a very important argument. Has each one of you understood this aspect, that if the feature, I'll repeat the sentence and I would like you to make sure that you've understood the statement. If the feature benefits the holder, the bargaining power of the holder will decrease and he will have to accept a slightly lesser return. If the feature benefits the borrower, the issuer will have to pay a slightly larger return to the holder. In simple words, nothing comes for free. You will have to pay for every extra feature that you buy for. Are we clear on this? Simple argument, but a very important argument. Okay. Having said that, I would like you to just read this question right here and take about 30 seconds and tell me which option do you think is correct, A, B, or C. So take 30 seconds and try to tell me which option do you think would be correct in this regard, A, B, C. I need more participation, guys. So I need more of you to participate in the class. There are many more than who have responded. So it's a multiple choice question. There is nothing, no negative marks for putting an answer out. At least you can try. Okay. I'm glad to see more responses coming up. Let's now try to analyze this question and respond to it. The coupon rate on a floating rate note makes payments in June and December and is expressed as a 6-month LIBOR plus 25 bips. Assuming that the 6-month LIBOR is 3% at the end of June. So here it was 3%. And it was 3.5% in December. So 3.5% here. The interest rate that applies to the payment in December. So the payment has to happen here. The question is, what is the rate at which the borrower will pay here. You have rightly pointed out it is not answer A, it is not answer B. Answer B is surely not the answer. That we are clear of. I think so. All of you have answered either A or C. Now, what is the correct answer? Let's work with that. Interest rate is always decided in advance and paid in arrears. Even if it's a floating rate loan, the rate is decided in advance and paid in arrears, like just your salary. When you work in a company, you start working from the 1st of the month and you work till the 30th of the month. Your salary is decided, the amount of salary to be paid to you is decided at the 1st, but paid to you at the 30th. Same way, the rate gets decided here and paid here. The rate gets decided here and paid here. So what will be the payment to be done here? 3% plus 25 bips. That means about 3.25% in December. What will be the payment in June? 3.75%. So even if it's a floating rate loan, the rate gets decided at the beginning of the period and gets paid at the end of the period. For the next period, again, the rate gets decided at the beginning of the period and then gets paid at the end of the period. Okay. This is true for every single loan across the world. No exceptions to this. Every single loan works in this manner. Okay. So coupons are paid in arrears. The coupon rate first accrues and then is paid. It's not paid in advance. And the rate at which it accrues is decided at the beginning of the period. Okay. Now, have you ever seen a legal document? I am sure you have. I'm sure each one of you have seen some legal document somewhere at your age. Any legal document, any stamp paper, whether it is a rent agreement or it is another agreement, any agreement always starts with what are the first few lines of the agreement? First few lines that this agreement is between Mr. So-and-so, son or daughter of so-and-so, resident of so-and-so, with his picture, maybe with his ID card, with his Aadhaar card, with his identification very clearly mentioned. The identification of who are the parties involved is very, very critical. It might sound like a very obvious thing that I'm saying right now, but I'm telling you, this is one of the, in cases when the agreements get very complex, especially in the corporate world, these issues there can be very troublesome issues that can arise. I'll give you, let's say, an example. I'll give you an example where things can be a little tricky. Let's say the following situation happens. There's a bank which gives a loan to Mr. M. No reference to anybody, but just Mr. M. So bank gives a loan to Mr. M. Mr. M was very smart, and he, while signing the contract with the bank, entered a clause in the agreement and said that in case I default, you cannot take the money from Mr. S, who is my son. He is not liable to pay. He cannot pay for the loans if in case I default. Okay. So the bank has lent money to Mr. M, and Mr. M says, I will pay. My son or my sibling, my sons and daughters, they will not be paying this loan. Okay. So there's a very specific name to this here. This is called as non-recourse loans. These are called as non-recourse loans. Non-recourse loans are that in case the default arises, the bank cannot touch the personal assets of the subsidiaries. All right. So let's say it's a company. This is a parent company, and the parent company owns a subsidiary. The parent company owns a subsidiary. The parent company signs an agreement with the bank of non-recourse. of non-recourse, where the bank has give the money to him and the parent says, I will pay, my subsidiary can't, will not pay for this. Now, if in case there is a suspect fraudulent transaction here, where bank gives the loan to Mr. M and Mr. M transfers that money to S, and then Mr. M defaults. Now what will you do? Where will you go? Mr. M says, do what you have to. I'm not going to pay your money back. Now the bank cannot touch his assets. Bank cannot go to him and recover the assets. Legally not allowed, because it's mentioned in the document. You can't do anything about it. And Mr. M says, I am bankrupt. I don't have money. Take whatever is left in my bank account. Take it. Troublesome. So in this scenario, the bank was not smart enough to give the loan. How can the bank ensure that such a situation does not arise? Banks have learned their lessons, and these are they are very old examples, but yes, banks have learned their lessons. So usually what the banks do now, and this happens for every single loan, okay, not just corporate loans, every loans. Banks do not pay money to Mr. M directly. Banks ask Mr. M to create a separate entity called as an SPV. SPV stands for Special Purpose Vehicle. SPV stands for a Special Purpose Vehicle. This vehicle or this entity is created only for the purpose of this loan. The minute the loan is going to be paid back, this entity is going to be dissolved. So the bank gives the loan to the SPV. Mr. M transfers the asset, the collateral, the documents against which he is taking the loan to the SPV. And the SPV then transfers the money to Mr. M. The ownership of the assets, collateral, lie with the SPV till the time Mr. M does not pay the money back to the bank. In case Mr. M tomorrow defaults or goes bankrupt or does anything, he cannot touch this asset. This asset lies in a separate entity and cannot be touched by Mr. M. Therefore, the bank can recover the assets, recover the money slightly easily. This entire thing is called as a bankruptcy remote vehicle. This entire concept is called as a bankruptcy remote process, and SPVs are created in order to ensure that. So the legal entity of the issuer is very important. If the holding company, in this case, Mr. M, was representing the parent company or holding company with fewer assets or lesser credit rating, issues a loan with no recourse to assets held by subsidiaries, the holder would face a high credit risk. SPVs can be created in this process to ensure bankruptcy remote vehicle, because if this company M declares bankruptcy, the other creditors, suppliers, employees of the company M cannot touch this asset here, which is lying in the SPV. It's like creating a separate place where the assets are kept in order to ensure that these assets are segregated and said that, oh, these assets belong to somebody else till the time the loan is not paid off. Banks today force almost every borrower to create such an entity before they can borrow. Legal entity of the issuer. Okay.
Sir, here non-recourse is no collateral.
No, non-recourse is not zero collateral. Non-recourse is that the collateral lies here. Okay, so imagine this. I take a loan against my car. Okay, I take a loan against my car. I go and I sell the car in the market to somebody. He gives me the money, I spend the money, I pay off the money to somebody else also. I just transfer the money to somebody else. 2 months later, bank realizes and comes and says, give me the loan. I say, sir, there's no money that I have. So the car is gone. Asset is gone, collateral is gone, money is gone. Bank is saying, what do I do now? Do you get that point?
Yes.
Yes. It might sound like an easy thing to you right now, and say the bank can file a police case and all of that. Who wants to get into that situation? Nobody wants to get into that situation in the first place. Recovery of that asset is no longer easy anymore. The bank will have to prove that they had given a loan against it. Getting authority on that asset, somebody else paid for it and is using it now. He may have done something else with it again further. And why just talk about a car? It could be a machinery, it could be a land, it could be many other things, which are very difficult to then keep track of. So therefore, keeping these assets in a separate investment vehicle creates a bankruptcy remoteness. Okay?
Yes.
Excuse me, sir.
Yes.
So in this example you've given of this car, so in SPV, the bank is going to keep the car as an asset.
He will keep the documents of the car with him. Okay, so in retail, see, in case of retail loans, what happens is the official documents of the asset are kept with the bank. The bank holds the documents. But in larger corporate loans, what happens is keeping documents is not enough. You have to create a separate balance sheet, a separate legal entity. Because like for example, let me give a simple example. If a company defaults, who gets the first claim on the company? Supplier, employee, or bank? Think of it. Company owes money to supplier, employees, and banks. Who will get the money first within these three people?
Bank.
No. Technically, supplier. Technically, the supplier might get the money first, because the supplier provides the cost of the goods sold. He goes first, then the employee. Bank might get last. But banks are smart. Banks say, no, sir, you can't do that. Why do the banks get it first? Because banks create separate investment vehicles and they say that asset belongs to me till the time you haven't paid the money back. This asset cannot be used for somebody else. Because if you look at the income statement structure, the employee salary goes before interest. Cost of goods sold goes before that also. So the priority is slightly different. But bank is saying, sir, I will get the priority. And to do that, you have to create a separate vehicle. Is that making sense?
So,
Yes.
sir, if like this SPV is not there,
Hmm.
and already the persons who are already much rich and very familiar or very used to these cases and police thing, they must take obviously an added advantage to this thing that they have.
You can say that, but buddy, it's very difficult. You know, in bank is not in the business of recovery.
Yes.
You have to realize that banks are not recovery agents. Why is in 20, if you heard the 2021 budget, do you know the finance minister has recently announced that they will be launching a bad bank. You know why? What is a bad bank? A bad bank is where all the banks will transfer their bad assets to this bad bank. Who will be the recovery agent? Because banks don't have the bandwidth to do recoveries. Getting into recovery is a very difficult task. The legality, the management, the cost, the time that it takes to do all of that is humongous. Once the default happens, then proving it that this is mine and what is yours and who will get the money, that takes years. You know how the legal system works here.
Yes, that is also this rich people already, like huge businessmen, they could take obviously an advantage over this. They don't.
Well, if the system is strong enough, Akshay, that would not happen, right? So the systems need to be built. That's why the recoveries need to be strong enough. The authorities need to be strong enough to be able to, for people who want to circumvent the law, should not be allowed to. And that's why these contracts have to be structured good in advance itself. So if you create these structures well in advance, then these situations itself will not arise as much. Of course, people still figure out ways here and there, but the fact is that if you make the law strong, then the likely incidence of such incidents is less. Creating a separate investment vehicle, an SPV, is one of those ways to do so. Okay.
Sir,
Yes,
for
Devyani.
example, Mr. M in this example has taken a loan for his child for a education loan basically.
Huh.
So what do we keep in SPV?
See, now there are different types of loans. There could be secured loans and unsecured loans. If it's a secured loan, you provide a collateral, a guarantee, a security. But if it's an unsecured loan, you don't provide a guarantee. And in that case, the interest rates are higher.
So then
For
there's
ex-
nothing in SPV.
If there is no security to back it up. For example, do you know what is the interest rate that you were to pay if you take a loan on credit cards? Any guess? What is the interest rate on a credit card loan? Because it's an unsecured loan. So if you have a credit card, just call up your credit card company, ask them what is the interest rate that they charge on the loan that they give you. In case you want a cash loan, what is, because on a credit card also you can withdraw money and get some interest rate. Okay. You know how much? 3.5% per month is what the credit card company charges you. 3.5% per month. No, in order to annualize it, don't multiply it by 12. Don't do that. You know time value of money, you know the impact of compounding. It will be 1.035 raised to the power of 12. Calculate and check. If you're not astonished, then tell me. No collaterals loan are expensive. If you don't give a collateral, the interest rate that you will end up paying will be crazy amounts high. The personal loans will be expensive. So if you're taking a student loan also without collateral, the interest rates would be higher.
But so again, the point is that if the person is not able to pay the loan, then they can't take anything.
Yeah. I mean, so that's where you have to, it's a difficult business to be in, right? So you have to try and give loans to people who can pay back. But then if you can pay back, then why would you take a loan in the first place? Right?
Yes, sir.
So there's a chicken and egg situation. So you got to work hard. You got to work hard. Another thing that is usually asked when you borrow money, the first question that the bank actually asks you, how will you pay back? So follow up from your question, Divyani, is the question being asked by the bank, how will you pay back? So the bank, what does the bank ask you? What kind of documents does the bank ask you when you take a loan? They ask you about your salary. They ask you about your income, assets, and they ask you how will you pay back. If it's a if it's a business that you're doing, you could be paying back by the project that you're doing. If you're the government, you could pay back by the taxes that you raise. If you are any other entity, you could also pay back by refinancing. Refinancing. This is refinancing. What is refinancing? Refinancing means you will take another loan to pay back the previous loan. You will take another loan to pay back the previous loan. So repayment of the previous loans is made by taking another loan. It's called as, the name, one word for that is called as refinancing. So the source of funds. When you take loans, you need to provide collaterals. Collaterals could be in the form of physical assets, financial assets, or properties. So collateral reduces the credit risk in a bond. Debentures, sometimes people say, oh, sir, what are debentures? Debentures are bonds, but debentures are a type of bonds which are unsecured. Unsecured. So collateral must be in the form of securities, and debentures don't provide any security. They are unsecured bonds, and that's why the interest rate on those bonds is higher. Collateral can be in the form of securities, financial assets. If the security being provided is a financial asset, it's called as a collateral trust bonds. If the collateral is a physical asset, it's called as an equipment trust bond. If the collateral is a property, you call it as mortgage-backed security. So different types of collaterals mean different types of bonds. You could have collateral trust bonds, equipment trust bond, and mortgage-backed securities. Now, just offering a collateral is not enough. Listen to this carefully. Just offering a collateral is not enough. What if the collateral value goes down? Take an example. Let's say you've taken a loan, a car loan. Let's say you've taken a car loan, and let's say the car was worth 5 lakhs. the bank lent you 4 lakhs. Okay, so listen carefully. So the car was worth 5 lakh rupees. You put 1 lakh from your own pocket and you took a loan worth 4 lakh rupees and you bought the car. You drove the car in Delhi, and like the way people drive in Delhi, you banged it pretty badly somewhere. And to the extent that you banged it, the price of the value of the car dipped, and it's now worth 3.5 lakhs. Even after repairs, etc., the worth of the car in the market today is 3.5 lakhs, but your loan outstanding is 4 lakhs. What's happened? Your loan is 4 lakh rupees, but the collateral provided today for that car is 3.5 lakhs. You have an incentive to default. You have an incentive to default, because if you default, you will be parting away with an asset worth 3.5, but your liability will reduce by 4 lakhs. So very often people in such circumstances default and say, sir, take the car. Covered bonds provide you guarantee against such a situation. Covered bonds are senior debt obligations that provide dual recourse, both by the issuing financial institution and the underlying asset pool of segregated assets, which can be placed in the SPV. Thus, they retain a top priority and have a low credit risk. In case of a covered bond, what happens is that in case the value of the collateral falls, the borrower is liable to provide extra collateral to bring back the value of the collateral back up to a certain amount. So the collateral must be now brought up by, to let's say 4.5 lakhs. So you might have to provide extra collateral because the collateral has gone down in value. If not, then you would have to probably immediately liquidate the asset and get the loan back. So covered bonds provide extra guarantee, extra security, that in case the collateral value dips beyond a certain point, extra collateral has to be provided by the borrower to ensure that the loan has enough collateral, because the value of the collateral must be worth more than the loan outstanding. The lender is still not happy. The lender is still not happy, and he's asking for credit enhancements. What are credit enhancements? Credit enhancements are additional collateral, additional guarantee, additional security being asked by the lender for protection. And there are two types of credit enhancements, internal and external. Internal means within the bond structure, and external means a third party guarantee. Internal credit enhancements rely on the structural features of the collateral of the guarantee of the bond. For example, waterfall structure and over collateralization. Over collateralization means that the value of the collateral is worth more than the loan. There's a very popular ratio called as loan to value, LTV. Loan to value. If loan to value is less than 100%, we call that situation as over collateralization, where the value of the collateral is worth more than the loan that has been issued by the bank. Waterfall structure. Waterfall structure creates a priority of payment. Who gets the money first, second, third? So if we create a waterfall structure and create a priority of payment, that ensures that the money first goes to party 1, party 2, and then party 3. So internal credit enhancements rely on the structural features regarding the priority of payment, ensuring that extra security is being provided within the rules of the game, within the rules of the bond. Sometimes the lender is still not happy and he asks for guarantees from third parties and say, bring me another person who can work as your guarantor. In case you default, I will go and ask that party. This is called as a surety bond. A surety bond is a case where in case you default, I will turn my focus to that party who has served as a guarantor to you. In case you default, I will take money from you, the third party. You will guarantee him. So you call your friend, your relative, and say, sir, please work as my guarantor. In case I default, you will have to pay up. That's a surety bond. The lender in such a case suffers risk that in case the borrower defaults, it's possible that the third party might also default. Possible. Letter of credit is also third party guarantee and is very often issued in transactions of trade, export, import, or transactions where the buyer and the seller are unaware, don't know each other, and they don't know how to transact. Should the buyer send the money first, or should the seller send the material first? Well, if the seller sends the material first, the buyer might not pay up, or may start negotiating, or may delay the payment. The buyer might send the payment first, and the seller might not send the material properly. So that transaction cannot happen. So there comes a middleman in the process who is a trustworthy party. He issues a letter of credit and says that, okay, the money will be paid in case the material is supplied. So on the trust of that person, the transactions work. It's like a loan. The third type is called as a cash collateral account. A cash collateral account is like taking a loan against your FD. Sometimes we make fixed deposits. We make fixed deposits for 3 years, 5 years, 6 years, 10 years. But we require money immediately for the next 1 week. Let's say for the next 1 week, I require money, or 1 month, I require money for short-term liquidity purpose, but I don't want to liquidate my FD. So how do I do it? I go and borrow against the FD itself. This ensures that the probability of default is really low because the lender technically already has a collateral worth more than the loan that you have taken. And this is the safest form of third-party securities. And then you have covenants. Covenants are the do's and don'ts. And we gave you examples of the affirmative and the negative covenants. The negative covenants are the restrictions, and the affirmative covenants are the things that you have to do. Based on what we have read till now, I'm going to give you a couple of minutes. I'm going to pause myself and I'm going to give you a couple of minutes, and I'm going to ask you to do these 3 questions. So I'm going to pause myself. I'm just going to go off the screen for a minute, and I'm going to ask you to do these 3 questions, and we'll discuss. Okay. So try these 3 questions. Okay. Good to see some of you have responded to the questions. Let's try and discuss these 3 questions, and we'll start with number 3, then 2, then 1, because that will be easier for you, because number 1 is slightly more. I'll have to discuss a little bit more. So number 3, very easy. The major advantage of issuing bonds through a special purpose vehicle is to create bankruptcy remoteness. Easy, right? Now look at the structure of the question. I want you to read this question once again. The question says the major advantage. That means the other 2 are also advantages of issuing loans through an SPV. These are also advantages, but this is the major one. This is the big one. This is the major reason for it. This is the kind of question that you can get on the exam, where all 3 answers are correct. All 3 answers are correct, but this is the more correct than other 2. Okay. Question number 2. The external credit enhancement that has the least amount of third-party risk is surety bond, letter of credit, cash collateral account. Easy one. I already mentioned that to you. It's a cash collateral account because that is already has the cash against which you are borrowing. Question number 1. The individual or the entity most likely responsible for the timely payment of the interest and the principal repayment to the bondholders is the trustee, the primary lead bank of the issuer, or the treasurer or the CFO of the issuer. Now this question is difficult only if you don't understand who the 3 parties are. Let's go with option C. Option C is the employee of the company. If the company does not pay, will the employee pay from his pocket? Of course not. He can't be paying from his pocket. It's not his personal liability. If the company defaults, the company defaults. He can't be, the CFO of the company is not going to sell his house to pay off the loan. Primary or the lead bank of the issuer. He is the intermediary who has been hired by the borrower to help to sell the bond. He is not the party who's going to pay the loan back. In fact, he is just the broker. This guy is just the broker in the middle. His job is only to help the borrower raise the loan Will the broker ever make any payments? Of course not. Ridiculous. So who is the trustee then? The answer is trustee, but who is the trustee? Basically, the trustee is a party that the lender appoints. So this is the lender and this is the borrower. The lender appoints a trustee who is responsible to go and collect the money from the borrower on a regular basis and pay the money back to the lender. His job is to ensure that the borrower is able to pay back in time. His job is to collect the money and pay back. If you were the trustee, what would you do? Let's say it is a 5-year loan. Let's say the 5-year loan, and this person has to make the payments on a 6-monthly basis. Every 6 months, he has to make an installment payment. My question to you is, guys, I want you to answer this. If you are the trustee, when will you go to the borrower to ask for the first installment? When will you go to the borrower to ask for the first installment?
Sir, can you repeat first installment?
My
When
question.
we have to
My
pay?
question is: there is a lender, there is a borrower, and there's a trustee who's been appointed to collect the money from the borrower. The loan is a 5-year loan, which has a tenure of 5 years. The payments has to be made by the borrower on a 6-monthly basis. The question that I'm asking is, when will the trustee go to the borrower to collect the first installment payment? And when will he ask for the first payment? Most people answer the question is either 5th month or 6th month. If the payment has to be halved in 6 months only, then what the hell is the trustee doing? You know, if I were the trustee, what would I do? I would land up on the borrower's head on the first day itself, on day 1. I will not wait till the last. It's like asking that your exam is in the end. When will you study for it? Last day. Will you be able to pass then? When will the trustee come and sit on your head? Day 1 of school. And say, start studying, buddy, now. Because you will not be able to study everything in the end. Last day, you will not be able to study the entire thing. You have to start studying now. So what will the trustee do? The trustee will go and sit on the head of the borrower and say, buddy, for you to pay the money at the end of the 6 months, start saving money now. Put money into a separate account and show me that you are putting the money separately. Because if you're not putting the money separately, you will not be able to raise it up in one shot in the last 1 month. Does that make sense? Now, if the money doesn't come in, who will the lender first catch? Who is the first party that the lender will catch and say, buddy, you haven't got the money? The trustee. Get it? Now, Rishabh, your question, who appoints the trustee? Trustee is appointed by the lender. The lender appoints the trustee. If the issuer was to appoint a trustee, then the issuer and the trustee will be friends. That is not okay. Can the issuer and trustee be good friends? Yeah, they can be good friends, but they cannot be the same party, isn't it? Because the trustee is the person who has to somewhat impose the discipline on the borrower. I think the example that I gave you, that your exam is in 6 months, when should you study? I think that should answer your question. When would the trustee come and ask the money from the borrower? It's not going to be that the 6 month. He is going to ask on the everyday basis. Every week, every day, ask for the progress, what is happening. Think of him like your parent. This is your exam. This is me, the lender. Got it? So that's this part here. And we've spoken about the idea of basics of bonds. We're at about 12:30. I won't stretch you any further. We'll stop at this point. I'm glad we were able to start with fixed income and we were able to run through at least the first few slides. I would like to encourage you to spend this week on doing a bit of the portfolio management topic that we have covered. That should ideally not take too long because portfolio management is not that difficult. It's not that challenging. So I'm hoping that portfolio management, you can cover it up relatively quickly. But I want you to spend at least about 3 days this week doing fixed income. I want you to spend the last 3 days, let's say Wednesday, Thursday, Friday, at least 3 days on watching the lectures of fixed income for the previous batch that we've conducted. I started out the class today by telling you that fixed income is probably going to be one of the more challenging topics by the end of it. You will realize that why I'm saying so. In order to make it simpler for you, in order to make this subject a subject which you feel comfortable with, happy with, I need you to spend at least about 3 days this week watching the lectures of fixed income that we have covered previously with the previous batch. Thankfully, fixed income content has not changed even a bit from the previous year. The chapters that I would like you to watch, I would like you to watch the remaining part of chapter 1, chapter 3. You can skip chapter 2. Chapter 2 is right now very easy. In the videos, you can skip the chapter number 2. I would like you to spend time on covering chapter number 3. So 3 days, cover chapter 3. Look at that. I'm giving you 3 days to cover one chapter. This will take that time. Okay. This chapter relates to the fixed income valuation. So I would like you to spend time on covering out the topic of fixed income valuation as much as you can. Trust me, you will be thankful and say that, yes, this is well spent time, because when you come prepared for the next weekend, you will be able to understand the content better and the interactions and the discussions will be far better. If you get time, you can move to chapter number 4 also, but chapter 3 is what I want you to cover by the end of this week and come prepared. On the next weekend, when you come in on the next weekend, my plan on Saturday, I will cover up all of chapter 1 which is left. I will cover up chapter 2 after that. So hopefully by break time, we'll be able to cover up all of chapter 1 and chapter 2. And we'll spend about 2 to 2.5 hours covering this chapter. We will still not be able to finish this chapter next class, but I will spend about 2.5 hours covering chapter 3. And on Sunday, I will complete this chapter and move to asset-backed securities. So by Sunday, I would be hoping I can cover these 4 chapters, and hopefully I can move on to the next study session also, which has 2 chapters. So in that study session, there are these 2 chapters. Let me show them to you. So these 2 chapters, and this chapter 2 is relatively short one, and this is a slightly longer one. Okay. So we will work with this next week. Let's see how we can pace up the entire prep. But yes, I'm hoping that by next weekend, I can cover up all of the fixed income except for maybe one chapter, maybe chapter 1, so that we can, we can cover up most of the fixed income by the next weekend itself. So 2 more classes. I don't think I'll be able to finish fixed income, but at least the major part of it, fixed income, I should be able to cover out. Okay. Rishabh, your point is Investopedia says that trustee is hired by the bond issuer. Can you please confirm this? See, you are right. Investopedia is correct. Investopedia is correct that the trustee is hired by the bond issuer. That who pays the salary for him? Who pays the salary for the trustee? Issuer, because it's a cost. So the lender basically charges the issuer indirectly for it. Okay, so technically the issuer is paying for the salary, but who does the trustee have to work for? The trustee has to work for the benefit of the lender. Yes, makes sense. So the salary of the trustee has to be paid by the issuer, but technically the trustee is working for the lender, for the protection of the lender. Okay. Couple of more questions coming up. Let me just read them. Akshit, why would the issuer appoint his own person to recover his money?
So that was not question I was asking. I was telling for above thing only.
Sorry, say again.
That is not a question. I was just answering the above question only.
Right. Okay. Okay. So see, the issuer has to appoint the trustee because the lender asks for it. The lender says who will collect the money, who will how, so it's like, okay, let me put it this way. You're the student in the school. Your parent is your trustee. Your parent is your trustee. The parent has already been appointed for. You can't change your parent, your guardian. So your parent gets appointed by your guardian gets appointed by your parents as well. But your guardian is responsible for your stuff that you prepare for, study for, etc., and your performance. So, okay, let me put it this way. Let's say the parents are not directly taking care of the child. The parents appoint a guardian for the child, and the child goes to school. So the parents have appointed the guardian, but who is the guardian responsible to? So the guardian has to work with the teacher in the school to see if the student is working properly or not. Isn't it? That's the way it works.
But here the parent is like a lender, no?
No, in this case, the parent is not the lender. The parent is the issuer. The parent itself is the parent is the person who owns the child. No.
But the person who's working is child.
Yes, the child is working. The child is supposed to pay back, right? He is the person who is responsible for the child, the parent or the guardian in that sense. So basically, trustee is hired by the issuer. Trustee is hired by the issuer, but he has to work for the benefit of the holder. That's how it works. So trustee acts on behalf, as Rishabh is saying, trustee acts on the behalf of the investors, but hired by the issuer. That's correct. That's how it works. Tanish, your question: why can't bank take collateral directly from Mr. M? Sometimes it's not easy to. Okay, let me. There is an example that comes to my mind sometimes when I talk about trustee and etc. Okay, listen to this carefully. So Tanish, I'm answering your question. Listen to this. Interesting. Imagine there is a dinner that has been served. Imagine dinner has been served on the table. There is a bowl of some vegetable or dal or fruits or whatever is. There is a bowl. Okay. I want to know what is my share out of that. Okay. I want to know what is my share out of that. How much will I get? What is the way that you can tell me? Can you put it in will you tell that, okay, from the bowl only you can take some amount? Or would it not be better that you take a bowl, you take a smaller bowl, put it aside, take one and put it aside and say, this is yours? Isn't that how it is done on every dining table? You have a bigger bowl and then you have a smaller bowl which is kept aside and said, this is yours. Why is that important? Why do you have to have a separate bowl? It provides clarity. It provides absolute clarity to say that, okay, this is mine and nobody can touch that then. If in case that bigger bowl gets finished, this smaller bowl is mine, you cannot touch that. Yes? Maybe this works with sweet dish at home, ice cream or chocolate cake that has been made at home. I'm sure now you can connect it with better, that the chocolate cake came at home and a separate piece was kept aside. But if the piece was not cut aside, then what would happen? Somebody might come and gobble up the cake and say the cake was kept in one straw. I didn't know that it was for you as well. So creating a special purpose vehicle, creating a separate allocation helps in creating a clear distinction as to who does this asset belong to. Does that answer your question?
Yes, sir, clear.
Yes. So keep in mind the chocolate cake. Whenever in doubt, chocolate cake serves most of the answers. Perfect. So I think that should help you out. I'll see you guys next week with the remaining part of fixed income. Do spend time on fixed income this week. Trust me, it will really help. Okay. I'll see you guys next week at 8:30 on Saturday. I hope you have a good time. Enjoy and have a good week. Thank you. Bye-bye.